Hi everyone, so before we start this video in terms of the 2022 predictions, just want to say thanks for everyone for last year. 2021 was a great year, but importantly as well, hit that subscribe button. We've got so much more content coming this year, so if you're interested and you're keen on what we're doing, hit that subscribe button and you'll be updated every time we have a new video launched. Importantly as well, we've got a great webinar coming up, which is what do we need for first-time investors? What can we do for first-time investors? So we've got a webinar coming up on that. So again, keep your eye out, subscribe to the video, and I look forward to a great year. Now for 2022, we had a great 2021. Let's be honest, it was one of the best years that I've ever seen in the property market from both a company perspective and of course from a buyer's perspective, and the way that the growth took place, and of course from a rental perspective, we know that landlords had a bumper year indeed. But of course, what's going to happen in 2022? That's what everyone's looking at. So what we're going to do today is discuss not only our opinion, but of course what everyone else is looking at. We're going to go through Savills, Knight Frank, we're going to see what the FT, the Guardian are predicting. We know it's going to be different. We know that COVID is hopefully starting to wane slightly, and it's not as prominent as it was in 2020 or 2021. But we have got something else that's rearing its ugly head, and that's inflation. So look, without further ado, let's start heading down to the interest rates, where they are, what the history is, and then we can start to bring inflation in. So this particular screen here, you can see where interest rates have been. As we head back to the 80s, you can see that they were well over the 15-16% mark. Again, they only really started to come down as we started to get to the mid to late 90s and then into 2000s. Now, why were they so high at this point? Well, what you tend to find is that when the government controlled the interest rate, which they did at this point, whereas now it's the Bank of England, when the government controlled the interest rate, they typically manipulated it around election time. It depends on what voters that they wanted to capture. Now, that wasn't always the only rule. There were other rules, of course, inflation and things like that. But you did tend to find there was a lot more scope for manipulation when the government controlled the interest rate rather than the Bank of England. But if we look at things after 2000, because that's more in recent memory. So if we look at after 2000, it was pretty consistent, circa around between 4 to 6%, but around 5% on average. And you can see this point here. This was kind of 2008. This is when we saw the crash. So the Bank of England had to do something. Economies around the world had to react. And we saw that the interest rate plummet to try and kickstart the economy. And of course, kickstart it did. Now, we didn't really come out of that for a good few years. But around this point in time, London became extremely cheap. So you started to see people get back into the market 2010 into London, 2011. But the interest rate actually remained really low right the way through, even where it is at the moment. Now, we know that the interest rate was at a historic low at 0.1%, and in December they raised it. But that's because here in the UK we've got inflation, it's pushing over 5%, and 2%, 3% is okay, we can deal with that. The Bank of England have to write a letter actually every time it's above 2% to the government to explain why. But the reality is they start to push up to 5 and 6% as we're seeing. It starts to become a little bit uncomfortable. So if the cost of living is increasing dramatically, they need to do something, and the first port of call is they raise interest rates. But as you can see here, there's been a lot of talk about interest rate raises, or rises I should say, and there's been a lot of talk about how it's going to affect the property market, and is it going to dip in 2022? Now, I don't think so, and the main reason why, I think it's going to slow down the growth, but I still think we're going to have the growth. But the reality is that we're nowhere near what it was back in sort of like 2000 to 2008/9. So we're nowhere near this level here. I think it's going to start to increase over the coming 3, 4, 5 years, but I don't think we're going to get back anytime soon to these levels. So let's talk about what happened in 2021, and let's talk about what we expect to happen in 2022. So as we flip over to the Zoopla UK House Price Index, now the reality is we're still down in terms of flow of new supply of homes. You can see here that we've got 9.5% negative new supply of homes, where we've got a demand for homes, it's up 16% year on year. And the current house price growth is 7.1%. Now that's phenomenal for the year. And if we actually go right the way down, and for those of you that watch these videos on a regular basis, if we actually head down here and we start to look at the actual cities, you know that Liverpool is over 10% for the year. Manchester has a growth of 8.5%, Nottingham 8.1%. Now that's phenomenal growth, because on top of that, landlords will also have their rental income as well. So if we take rental income on average 4.5 to 5.5%, you're comfortably making anywhere between 13 to 15%, depending on where you have your property. Now that is an astonishing rate of return. You do that for a few years and you can imagine how many more times you're making money in terms of property than you are with the bank. So first of all, that's what happened. Now, do we think it's going to continue at that rate? Initially, it probably will for the first couple of months, but we don't think it will by the end of the year. And as I say, the main reason being is we think a lot of people initially got out of the cities. And this is people living. Now, there's a big disparity between renters and people that want to live outside of the cities. Typically, the reason why people got out of the cities initially is because they had either a child, children, young children, so they wanted more space. That's first and foremost. So they would have got out of an apartment and they would have wanted more space. However, what we're seeing now is the demographic who want to be back in the city centres is the younger demographic. They've had 1-2 years at home with mum and dad, and they want to be back in the thick of it. They want to be right back in the mix of it. Restaurants, bars, going out with their friends because they've not seen them for a year or two. And this is what spurred on the rental market, as we've done a report on this recently as well, in these areas. So if you look at the rental markets for Liverpool, Manchester, Nottingham and so on, all of those grew. So it's a phenomenal time to be a landlord. So what do we expect? Now we expect great growth still. We expect anywhere between 4.5 to 5.5% in terms of growth. Some cities will do a bit more, some will do a little bit less, but the reality is we still expect great growth because the interest rate is still set to remain at a low level. Even though we're coming up to February, we're coming up to another rate decision, and I pretty much expect them to raise it slightly then because inflation is still kicking in. So I do expect them to raise it again. What are they going to go to? I mean, I can't see them putting it up to 1% personally, but maybe they'll put it up to 0.5%, and I don't think we're going to see a dramatic change on mortgage rates that's going to put people off buying. There is still that appetite, and as we head back to the Zoopla House Price Index, we know that there is still that appetite to buy. We've still got a huge demand and a cut of supply. So I think that we'll still move along around about 4.5 to 5%, as I say, on average. And I do still predict that the northern powerhouse and places like Liverpool, Manchester, Leeds, Sheffield, Nottingham, they are still the places to buy. And I still think that if we compare those to London, and I really think London's going to struggle because the reality is the affordability is not there. So what we tend to find is that people simply can't afford to go and buy those prices in London. They rent, but again, the percentage that you get as a landlord, 2-3%, just doesn't cut it in comparison to what you get in the north. So look, as we head to other agencies and what they're predicting, so let's look at Savills. Now this was as of November, you can see here, November 2021, they published this. They think that the Northwest will do 5-year on average 18%. Yorkshire, again, 18.8%. And pretty much the North is is all above 17.5%. So over a 5-year period, they expect growth-wise to make 17.5% plus. On top of that, if you've got 5% a year coming in, so you've got 25% a year in terms of your rental returns as well, then you're looking at an astonishing amount. You're looking at close to sort of 45% in terms of your return over a 5-year period with a mixture of growth and income. Now, of course, as we head down to London, they're predicting it's going to be 5.6%, just over 1% a year growth, couple of percent a year in terms of your rental returns. So over the same period, you look at around about 18% income and growth in London, whereas you'd be well over the 40% in terms of the north. So we're still really actively marketing this particular areas or these particular areas and other things. This is based on traditional lets. If you do short-term lets, we've got a trademark part of our business which is called Skylet, and again that is short-term lets. We know that we can generate 8 to 10% returns plus, especially if you get in the right area, close to a tram stop, close to football stadiums, close to concert stadiums. Again, we know that there's great returns in these particular areas. And by short-term nets, I'm talking about things like Airbnb, Booking.com. We're on those particular portals, and that's where you want to be if you want to make the big returns. So again, as we look at Savills, you can see here that they are looking at great growth. And again, if we're looking at the FT, the predictions here, they still expect to keep growing, as you can see here, but they're going to be at a flatter pace, which we totally agree with. Prices are expected to go up 1% in 2022. We feel it's going to be a lot more than that. That would be typically on average. We feel it's going to do a lot more than that, of course, especially in the north. And again, what we're seeing here is the bank rate surprised markets by raising its bank rate for the first time in 3 years from 0.1 to 0.25. Personally, I do feel, but at the end of the year, we'll be on at least 1%. Personally, I think that the reality is they've got to combat inflation, or they've got to be seen to be doing something to combat inflation. So I wouldn't be surprised if they raise it in Feb to 0.5 and then another couple of rises up to 1% by the end of the year. But again, the reality is, even if we head to 1%, let's head back to these rates. If we head to 1%, what you'll basically be seeing here is something that is nowhere near the levels of where they were back in sort of 2008, 2009. In regards to the FT, as I say, you can see here what house prices have done. We had a number of people who bought around these areas, and we had a number of inquiries in 2015-16, and I remember in 2015-16 a number of people waited. They thought that the market had overheated, and those people waited. They're probably still waiting now. The reality is we always say to everyone, if you're looking at property for a short-term period, don't do it. It's the wrong market. There are so many taxes involved when you pay stamp duty. The reality is you hold it 1 or 2 years, you're not going to make much money on it. But if you look at more medium to longer term, you can see here the reality is the property price, even if we take into account this dip in 2008 here, everyone thought that the world had ended, and the reality is look at where it is now compared to what it was back in 2008. So we know that medium to longer term, the house price growth is going to be there. So there's never a perfect time to buy. And again, even if we took the ideal time back in 2008, very few people would have had the bottle to go in at this particular point in time. So as we sort of then head to the Guardian, again, here you can see that they're all predicting a pretty similar thing. It's expected to stabilise. Potentially a bit more difficult for first-time buyers, but what does that mean? So if the property market, as it says here in the Guardian, if price rises are going to make it difficult for first-time buyers, well, what do first-time buyers do? They rent, and if they rent, what does that mean? Well, it's better for landlords. So our particular market that we're aiming for, it's a great time for a landlord to get invested, because it is tough for first-time buyers. But that, for every negative, there's an advantage. The reality is it might be a negative for first-time buyers, but it's a big advantage for landlords and those who are looking at buy-to-let. Again, you can see here 2021 was the strongest year since 2007. £316 billion worth of home loans were given. And again, we still think that's going to keep on increasing. You can see the same graph here from what we saw in the FT. But as I say, we don't expect it to do those 8 to 10% returns, but we do expect, guys, at least 4.5 to 5%, especially in those northern cities. So our advice, guys, of course, we're really bullish, we're really positive on the property market. And the reality is even in those cities where we don't think there's 8 to 10% growth to be had anymore, there are still pockets where you can find great short-term lets or Airbnb opportunities where we can get 8 to 10%, but rather in the growth, we're getting it in the income. So look, hope this helps, and if there's anything that you'd like to ask us, feel free to email in. I look forward to speaking to you soon. Take care.